All right, let's dive right into this explainer. Today, we're unpacking a massive, fundamental shift in how the market is treating artificial intelligence investments. We've officially moved from the whole build it and they will come era into a much more ruthless, show me the returns phase. If you've been tracking AI infrastructure or just watching the markets, you know something huge is bubbling under the surface.
To really set the stakes here, I want you to think about this number, $725 billion. Big tech, specifically the four largest cloud hyperscalers, is on track to spend a staggering $725 billion on AI infrastructure in 2026 alone. That is up 77% from the previous year. It's just a breathtaking amount of capital pouring into data centers, chips, and power grids all over the globe.
So here's our game plan for today. We're going to look at that massive $725 billion bill, dive into this new show me phase, and see exactly who is winning and who is getting punished by the market. Then we'll do a reality check on Tesla and wrap up with what all of this means for your own portfolio strategy.
Okay, kicking things off with Section 1, the $725 billion AI bill and big tech's evaporating cash flow.
This really illustrates the incredible squeeze we're seeing right now. Normally, the post-pandemic average for projected Q3 free cash flow across giants like Amazon, Alphabet, Meta, and Microsoft sits super comfortably around $45 billion. But projected Q3 2026 free cash flow, it's expected to plummet to roughly $4 billion. The cash that once made these companies look practically invincible is just being entirely eaten up by the sheer scale of buying chips and securing power.
Which brings us right to Section 2, the show me phase. The era of patient capital? Yep, that's completely over.
And this is laid out perfectly in this latest market intelligence report from Atlas Financial Group following the Q1 2026 earnings. The investment narrative has completely pivoted. For the past couple of years, the market basically gave a free pass to anyone aggressively spending on AI. The assumption was simple: spend today, dominate tomorrow. But according to Atlas, that blank check has vanished.
So what exactly is the show me phase? Well, it's essentially a market reality check. It's a period where investors stop paying for pure potential and start demanding visible, near-term evidence that all this AI spending is actually generating profitable returns. Companies have to prove they're expanding margins or accelerating revenue right now. Just building the infrastructure, it's simply not enough to keep Wall Street happy anymore.
Let's jump to Section 3, rewarding the AI winners. We're talking specifically about Alphabet and Amazon.
The market absolutely loved what these two had to show recently. Their massive infrastructure investments directly translated into surging cloud revenues. Google Cloud just demolished expectations with an 82% revenue growth rate, and Amazon's AWS hit its fastest growth in over 3 years at 28%. The link between the money they spent and the money they made is clear, measurable, and highly lucrative.
But what's truly wild is how Alphabet is pulling this off. They actually bumped their 2026 CapEx guidance up to a staggering $205 billion. They are spending so aggressively that they recorded their first ever negative free cash flow, nearly $6 billion in the red. They even had to raise roughly $70 billion in stock and bonds just to fund it all, and yet the market accepted it. Why? Because their cloud operating margin expanded to 35.6%. That proves enterprise AI demand is real. And man, is it profitable today.
Now, let's flip the coin with Section 4, punishing the heavy spenders. This is where Meta and Microsoft are really facing the heat.
Take Meta, for example. The disconnect here is just huge. They posted exceptional headline numbers. Revenue growth was up 33%, which is their best pace since 2021. You'd think the stock would soar, right? Instead, it dropped up to 7% after hours. The catch? They raised their full-year CapEx guidance to a massive $145 billion, but they couldn't show investors a visible way they were going to monetize AI outside of their core ads business. Investors just outright refused to underwrite that spending without immediate proof of returns.
And then there's Microsoft, which is honestly the perfect poster child for this new era. Their AI is working flawlessly. Azure cloud growth beat guidance at 40%, and their AI revenue hit a massive $37 billion annual run rate. Despite that incredible performance, shares still fell 3% after hours. The big takeaway? Market fears shifting. Investors aren't worried the tech isn't working, they're terrified of the price tag. They're looking at these infrastructure costs and worrying that margins are just going to get totally crushed over time.
Moving on to Section 5, the Tesla reality check, or as I like to call it,
Waiting for the robo-taxi. To really unpack Tesla's recent Q2 earnings, we need to apply what we call the cash register test. It's pretty simple. You ignore the flashy headline net income, you filter out the non-operating or paper gains, and you zero in on the actual, cold, hard cash flowing through the core business. We have to separate the money earned from actually selling cars from the marks on a spreadsheet. When you run that test on Tesla, the results are, well, they're pretty eye-opening. Out of their $1.11 billion Q2 net income, roughly two-thirds of it had absolutely nothing to do with selling cars or storing energy. Believe it or not, it came from marking up a stock market gain on shares of a completely different company, SpaceX. The actual core operating profit, that was only about $351 million. And when you strip away that SpaceX windfall, you see the real squeeze happening to their core business. Look at the shift from 2025 to 2026. Operating margins tanked from 4.1% down to a razor-thin 1.4%. Free cash flow actually flipped negative by over $1 billion. Why? Because capital expenditures shot up 142% to almost $5.8 billion to fund all their future compute projects.
So, put that side by side with Alphabet. Alphabet is taking massive, growing cloud profits today to directly fund their AI buildout. They are proving their return on capital right now. Tesla, on the other hand, is draining shrinking car profits to pay for unproven futures like robotaxis and the Optimus robot. They are eating heavy AI costs today, just waiting and hoping those autonomous revenue streams actually show up tomorrow.
And frankly, Tesla seems to be quietly lowering expectations themselves. They recently scrubbed the words volume production from their written guidance for the Cybercab and the Semi. Add in the fact that independent trackers estimate their unsupervised robotaxi fleet is only in the tens of vehicles nationwide, and that trailing CapEx is now eating up 69% of their operating cash flow, it just dramatically raises the pressure on management to prove these investments aren't a pipe dream. Okay, bringing it home with Section 6, your AI portfolio strategy and how to navigate concentration risk. Let's jump back to that Atlas Financial Group report, because it lays out a really clear playbook for this whole era. With billions flying around and market sentiment shifting literally overnight, you absolutely need a solid framework to navigate the turbulence.
The main thing to remember here, treating big tech like the Magnificent Seven as just one big generic AI bet is incredibly risky right now. As we've seen, this cycle is going to produce distinct winners and meaningful losers based entirely on who can actually turn this tech into cash. You've got to diversify, actively review your portfolio for concentration risk, and most importantly, know exactly where your companies sit in the AI lifecycle. Are they cashing in today or just promising you the moon tomorrow?
So I'm going to leave you with this final provocative thought to chew on. Ask yourself, is your portfolio intentionally invested in a profitable AI future, or are you unknowingly holding the bag for tomorrow's massive CapEx bills? The show me phase of the AI revolution is fully here, guys, and it is time to make sure your investments can pass the test. Thanks for hanging out with me for this explainer, and remember to always keep